Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of equity value versus enterprise value, what they mean and how to use them. If you're hunting for individual stocks to buy, equity value might be your headline figure. If you're evaluating a company as a whole, like a private equity firm or a strategic buyer, you care more about EV. Suitability for different investors. Different types of investors prioritize equity value or enterprise value based on where their interests lie, debt versus equity. Equity value resonates most with equity investors. If you're buying a stock, you're purchasing a piece of the company's equity value. This figure helps you understand the upside potential or compare the company's performance to others in the same sector. Enterprise value is more relevant to debt investors or professionals involved in acquisitions. Why? Debt investors focus on the company's ability to repay loans, which is tied to its total resources and liabilities, the foundation of EV. Similarly, buyers looking to take over a company need to consider both its debt obligations and cash assets to calculate the total purchase cost accurately. In short, equity investors care about equity ownership and the market's valuation of that ownership. Debt investors and acquirers look at the company as a whole, with all its obligations factored in. By knowing which valuation to use, you can tailor your analysis to meet your specific investment or decision-making goals. Would you rather own a piece of the pie, or are you interested in eating the whole thing? Equity value tells you about the slice, while enterprise value covers the entire pie. Situations to use equity value versus enterprise value. Both equity value and enterprise value are essential tools in valuation, but their relevance depends on the situation. Whether you're making investment decisions or analyzing a potential acquisition, knowing when to use each metric can guide you toward better conclusions. Mergers and acquisitions. When buying or selling a business, the distinction between equity value and enterprise value becomes critical. Each tells a different part of the story, and using the wrong one can lead to a skewed assessment. Enterprise value is the preferred metric for M&A transactions because it reflects the total cost of acquiring the business. It accounts for not just the equity, but also the company's debt and cash. When a buyer acquires a company, they're taking on the entirety of its financial structure, so enterprise value offers a full picture of what they're paying. For instance, if a company has a large amount of debt, enterprise value will highlight this obligation to ensure it's factored into the valuation. On the flip side, a company with significant cash reserves will see its effective cost reduced, as those reserves can offset other expenses. Equity value, while still relevant, is more useful for determining the return to shareholders. In an acquisition, the equity value represents how much money current shareholders will receive for their ownership. For example, if you're a shareholder, you'd look at equity value to see the price per share in a buyout offer. It helps assess whether the offer aligns with the market value or provides a premium. In short, acquirers focus on enterprise value to understand the true cost of the business, while shareholders concentrate on equity value to evaluate their payout. Investment analysis. When evaluating investments, the relevance of equity value versus enterprise value depends on the type of analysis and the investor's priorities. For equity investors, those buying shares of public companies, equity value is often the primary focus. It represents the market value of their ownership. Investors use this to compare the company's stock price to its market cap and assess whether it's undervalued or overvalued. Evaluate their return on investment if stock prices increase. For example, if an investor is comparing stocks within an industry, equity value gives insight into how the market values each company's equity, excluding factors like debt or cash. On the other hand, enterprise value becomes more relevant for comparing companies on a broader scale, especially across different financial structures. It's particularly valuable for calculating ratios like EV, EBITDA, which provide a clearer comparison of operating performance. Use enterprise value when evaluating a company with high debt versus one with no debt to ensure a fair comparison. Comparing companies in industries where large cash holdings are common, like tech or pharmaceuticals. Enterprise value lets you focus on the business itself, regardless of how it's financed. For instance, if two companies have identical revenues and profits but one has significant debt, enterprise value will expose that difference. By understanding these distinctions, you can apply the right metric to your specific needs. Are you trying to choose a stock to invest in? Equity value is likely your go-to. Want a complete financial assessment of a company? Enterprise value is your best bet. Common misconceptions. Understanding equity value and enterprise value can be tricky, especially with the many myths floating around. Investors and analysts often misinterpret these metrics, leading to flawed decisions. Let's clear up some of the most common misunderstandings. Misinterpretations of equities. Equity value seems straightforward, but it's often misunderstood. Many investors mistake it for the entire company's worth, which is not accurate. Here's why these errors happen. Confusing equity value with company value. A common mistake is treating equity value as the total value of the company. In reality, it only represents the value of shareholders' equity. It doesn't account for debt or cash, which impacts the actual cost of the business. For example, if a company has significant debt, its total value, enterprise value, is much higher than its equity value. Ignoring the impact of share changes. Investors sometimes overlook how changes in outstanding shares impact equity value. If a company issues new shares, equity value grows, but this doesn't always mean increased shareholder wealth. Similarly, share buybacks reduce outstanding shares, boosting equity value, even if the total business value hasn't changed. It's like splitting a pizza into more slices. Each slice gets smaller, but the pizza size stays the same. Overemphasis on stock price alone. Stock price grabs the most attention, but it's just one part of equity value. If you focus only on the price without considering outstanding shares, you might miss the bigger picture. A high stock price with low outstanding shares could mean a smaller equity value compared to a company with a lower stock price but far more shares. For investors analyzing companies, understanding what equity value represents, and what it doesn't, can help avoid overvaluing or undervaluing stocks. Misunderstandings about debt. Debt plays a major role in calculating enterprise value, yet it's often misinterpreted. Misunderstanding this can lead to errors in valuation and decision-making. Here's how misconceptions about debt distort enterprise value. Treating debt as separate from valuation. Some investors mistakenly ignore debt when analyzing a company's value, focusing only on equity metrics. However, enterprise value includes debt because a potential buyer would inherit these obligations. If you overlook debt, you're not seeing the full financial picture. Imagine buying a house. You wouldn't ignore the existing mortgage when calculating its total cost. Equating all debt as bad. Not all debt is negative, but some equate it with risk without context. While excessive debt can signal financial trouble, moderate or well-structured debt might indicate growth opportunities. For instance, a company with heavy debt but high cash flow might still have a manageable financial position. Enterprise value accounts for this balance, but misunderstanding debt can lead to overly cautious or aggressive decisions. Overlooking cash offsets. A common oversight is forgetting that cash offsets debt in enterprise value calculations. Large cash reserves reduce a company's net financial obligations, lowering its effective acquisition cost. Ignoring this can inflate perceived risk. Think of it like finding money under a couch cushion. It eases your financial worries. Understanding how debt impacts enterprise value ensures a clearer view of a company's worth. By factoring in both obligations and offsets, you'll get closer to true valuation accuracy. Don't let these misconceptions cloud your analysis. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.